Thank you very much for joining me on this recording in your advanced financial reporting class. My name is Ngadalo Joseph, and I wanted us to continue, and perhaps today this could be the last question practice series under the learning phase in your non-current assets. So we get straight on to a question and try to see investment properties. I hope you still remember these are assets held for capital appreciation or rentals to others. There's a case question before us. It says Bardock, a public limited company, operates in the fashion industry, has a financial year to 31st May X6. Bardock owns a number of prestigious apartments which it leases to famous persons who happen to be under a contract of employment, under their employ to promote his fashion clothing. The apartments are laid out below the market price or market rates. The lease terms are short, normally spanned for 6 months. The lease terminates when the contract for promoting the clothing terminates. Bardock wishes to account for the apartments as investment properties, with the difference between market rates and actual rent charged to be recognized as an employee benefit expense. The requirement is that we should discuss the above, how the above should be dealt with in the financial statements for that year ended. If you have got a paper and a pen, kindly please write the following. The apartments occupied in the question by persons who are under the company's contract cannot be treated as investment property. So if employees occupy company premises, such assets fall under the standard IS 16 PPE. Such assets are carried at cost or revaluation, or revalued amount rather, which is fair value. The difference between the market rate and the actual rent is to be treated as income forgone. The difference cannot qualify as an employment benefit, and by the way, employment benefits are dealt with under a different standard altogether. All right, so that is sorted out. I want us to go to a question that has got government grants. So we're supposed to have IS 20 there, not IS 14. We are told on 1st June 20X8, Epsilon opened a new factory in an area designated by the government as an economic development area. On that day, the government provided Epsilon with a grant of about 30 million to assist in the development of the factory. Now this grant was in 3 parts. First part, 6 million, is a payment by the government as an inducement to Epsilon to begin development or to begin developing the factory. No other conditions were attached to this part of the grant. Then $15 million of the grant relates to the construction of the factory at a cost of 60 million, meaning that the company should only look for 45,000 or $45 million. The land was leased, so the whole of the 60 million is depreciable over the estimated 40 years useful life of the factory. The remaining 9 was received subject to keeping at least 200 employees working at the factory for a period of at least 5 years. The number of employees drops below 200 at any time in any financial year. In the next 5 years, yes, in 5 years period, can I read that one? If the number of employees drops below 200 at any time in any financial year in this 5-year period, then 20% of the grant is repayable in that year. From 1st June 20X8, 220 workers were employed at the factory, and estimates that this number is unlikely to fall below 200. So we fulfill the grant's requirement. The requirement is that how do we explain the components of the grant? How do we explain how the grant of 30 million should be reported in the FS. All right. So a little bit of background again. Government grants refers to assistance that the government gives us in exchange for compliance with conditions. And of course, government grants falls under IAS 20. So it's very important for us to be a little bit ahead when it comes to the issues of government grants. So other government grants is broken down in three parts. There is a 6 million inducement. I think there is a 15 million factory contribution, and there is supposed to be 9 million grant with a condition that 200 employees remain under the employ of the company. All right, so let us deal with each component of the grant separately so that we can understand what is going on. So we start. The basic principle, and again I would like you to write something. The basic principle of IAS 20 is that grants should be treated as income in whichever period the costs they are expected to compensate occur. The basic principle of IAS 20 is that grants should be treated as income in whichever period the costs they are expected to compensate occur. Now let us look at the first 6 million. Since the 6 million does not have attached conditions, remember this was an inducement, it should be recognized as income in the current year. It can be recognized as other incomes. Then the 15 million factory cost must be spread over 40 years, and so allows the grant to be matched to those costs, to the costs, in two ways. We have got two approaches to grant accounting. There's what we call the net grant position and the gross grant position. So I'm going to write here net, where it's necessary, of course, grant position. In the net grant position, what happens is that we run with the net amount. When we consider, for instance, in this case, capital grants, we have got capital grants. What will happen is the CV of the asset will be, let me just write dollars here, CV. So CV of factory under the net grant position approach will be the total cost of the factory, which in this case was 60 million, minus 15 million, and of course you are getting a 45. Okay, and then we need to recognize depreciation. Again, that is an entry in the profit or loss, so let's remember that. Our depreciation looks as follows: 45 multiplied by or divided by 40 years. Okay, hope you're seeing what I'm doing there. Then we multiply that by, so when you check when did you get this particular grant, when you check you discover that we got the grant on 1st June. Now how many months do we have between 1st June and 30th September? So we have got from 1st June, so you've got June, July, August, September itself. My count was 4, so this particular asset will have to be depreciated over 4 months. All right, so that if you use your maths skills, you have 45 million divided by 40 years multiplied by our 4 divided by 12. Of course, I need to increase my yes. I need to increase my decimal places there. So the CV, therefore, of the assets under the net position will be 45 less 0.375. Again, we have 45 less 0.375. That's the figure that you have, but I think if we safe there. All right, I think it's supposed to be 0.375. All right, let's try to see here what's happening. Okay, that's what I have here, 44,625. That is under the net position. Now let us go to the gross position approach. Under the gross position approach, we need to run with the full value of the asset. So asset CV initially standing at 60 million. Maybe if I put millions here, that will help us. Yes. Okay, what else do you have? The depreciation will therefore be based on the 60 million. Just try to look up that one. 40. Then you multiply by 4 over 12. So we do the necessary. Because cosine 60 divided by 40. Then you have 4 divided by 12. Shows a 1 there. Let me just try to include the decimal places. Okay, that gives us about 0.5. So what's the CV of this asset? At the end, or before we go to the CV, let's discuss deferred income. The deferred income for this particular asset will be the amount of the grant divided by 40 multiplied by 4 divided by 12. Yes, so that's what you have there. Then now you come in, you say 15 divided by 40, then you multiply 4 divided by 12. Right, again gives me 0, but I think I can deal with that. Now I want you to notice that when you combine these two figures, by the way, this one can be put as a minus because it's income. When you combine these two figures, when you say this plus that, how much do we have? Again, we need to just include. I hope that you can see that this amount there is equal to that amount there. Okay, so the effect on the profit or loss is the same. The CV is not very difficult. All we need to do is to say this is minus 0.5. I think we all know that's 59.5. I don't need to waste time dealing with formulas there. All right. Now regarding the issue of the deferred income in the grant account, we need to be a bit careful. So we started with 15. Let me just put everything here. 15 minus, how much was our figure? The release was 0.1. Hope you can see that. 15 minus the point that, showing 15 again, but I think if we include that, it will show us that amount. So that the so-called short term, let's start with this. The short term government grant obligation, okay, will be the next, the next release, which of course should be for the full year here. And I'm getting, if I say, let me just make a little bit of some referencing here. 15 divided by 40. If I say that, I'm getting, let's just do that. Yeah, it's supposed to be equal sign. 15 divided by 40 in full. Wow, what's going on? I'm going to have just to that giving us the correct figures. Let's try it again. 15 divided by 40. I need points, Still. Okay, I'm going to just write it manually for you to see. 0.375. But it counts the same, right? 0.375. Okay, 0.375. I'll put a point here for the sake of, and then the long-term government grant obligation will be now the difference between 15 and 0.375. Okay, again shows us that, but I think we can still work around that one. Okay, so that's what you have there. I hope that you have gotten one or two things. Let us try to see if we can look at another question, and I think I'm closing with this one. Borrowing costs. Now again, borrowing costs, this is interest really that is to be capitalized in the cost of a qualifying asset, because for you to access funds from the bank, you needed to do so at a cost. We have got a question, and it says Zanzi company has the following loans in place at the beginning of the year. We have got a 10% bank loan repayable in 20Y3 long term, and the other one 9.5% repayable in 20Y1. So we have got opening balances and closing balances which are the same. On 1st January 20X8, Zanzi company began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawn down for the construction was 30 million on 1st January 20X8 and 20 million on 1st October 20X8. Calculate the borrowing cost to be capitalized. So our year is ending in December. Let me safely assume that. Okay, so this is a borrowing cost question with multiple loans, and I think the students must be careful. We need to first find average interest rates, okay, in this particular question, and after we have found that, we can proceed now to apply the average interest rate to the so-called principal amount that we are drawn down for the construction of an asset. Okay, so our average interest rate in that question will be 10% of 120 divided by 200. Now, how am I getting this? That could be a nice question. Look at the way these statements have been phrased. 120 goes with 10%, and then 80 goes with 9.5. Now, the total of these two principles is your denominator. 120 plus 80 gives you a 200. So you run with that. Excuse me. This time around we've got 80 multiplied by, not 80, but 9.5 percent. Okay, multiplied by 80 divided by 200. Alright. I hope you can see that. Let's just try to see what is happening here. Okay. Interesting. Let me just put a figure here. See now what is happening. This is, let me redo this one because time is not going to allow us to dilly-dally like that. I'm going to start with the point just to make it a little bit interesting. I said 120. Okay, let's see. Is it 10% goes with 120? 120 divided by 200 plus 9.5% goes with 80 divided by 200. So that's what you have there. Wow, again, same thing. Okay, I just need to create some space for it there. Okay, so when you do your maths, if we can just help each other do the maths there. We have got that figure multiplied by 120 divided by 200, then plus, you know, Excel follows board maths. Okay, I hope you can see that, multiplied by open brackets 80 divided by 200, and of course we need to close here. Yes, but we need to close there. There we go. There's the challenge. Okay, where is the challenge? So until we turn the other side. Okay, so maybe there's no need. Is there need for that to deal with that? Okay. Should I take them one at a time? Okay, if you can manually do this work, you'll find that your percentage that you're getting is about 9.8%, and then we have to apply that to our question. All right, so the 30 million, so you write here borrowing cost that I'm going to close very soon. Borrowing cost will be equal to, we have got millions of dollars, so the 30 million principal was drawn down on the first day of the year. So this one is straightforward. It's a 30 by 9.8%. Okay, that gives us, let me just put an equal sign there, 9.8%. Okay, so there's a 3 there. We did our decimals, we'll find that. And the second one was 20 million drawn down. Make reference to the question, please. If I check your question says the 30 million was drawn down. Okay, the 20 million rather was drawn down on 1st October. The other one was drawn down. So 1st October to December, how many months? We have got 3 months. I think this is not supposed to be very difficult. So again, 20 by 0.98 is 0.09. Yes, 0.09. That's a percentage there. Then multiply that by k by, 3 over 12 is as good as 0.25. So we just introduce the decimals. K, 3 of them, 3 decimal places, and then we sum up. Okay, so I'm getting 3, but again, if I use, I'll be getting that much. Okay, so thank you very much for listening. Thank you very much for your attention. So perhaps next time we have to embark on something different. Thank you very much.